You're listening to Bottomshelf Bitcoin, episode 24.
Relax. Enjoy your coffee. Okay. Good morning, everyone. Take a chill pill. Okay.
Hey everybody, welcome back to another episode of Bottomshelf Bitcoin, the podcast that puts Bitcoin knowledge within everyone's reach. As always, I'm Josh Humphrey, your host, and today my guest is Bitcoin maximalist, co-founder of the Satoshi Nakamoto Institute, and founder of BitcoinAdvisory.com, Pierre Rochard. Pierre, welcome to the show.
Hey Josh, thanks for having me on.
Yeah, absolutely. Thank you for coming on. And before we get into anything else, I just want to say thank you for the Bitcoin maximalist dinner that you guys did in Dallas. That was a lot of fun. So I really appreciate that.
Yeah, thanks for coming out to that. I agree. That was a huge amount of fun hanging out with a bunch of like-minded individuals in person.
And it was maybe the loudest room I've been in a very long time.
Yeah, that was crazy. And I don't know if the restaurant, if we broke a record there as well.
Yeah. Well, I was really impressed. This has nothing to do with anything I want to ask in the interview. I was really impressed when I stepped out of that room that we were in, that you really couldn't hear everybody. So whatever sound insulation they've got going on in those walls is top notch.
Yeah. Yeah.
Anyway, okay. So what is your give me an idea. What's your background, maybe even before Bitcoin, or I don't know, what do you do outside of Bitcoin, I guess?
Yeah, so I guess the first relevant part of my background, in high school, I got interested in like Linux and open source software, but I never programmed. And then I got really interested in Austrian economics, and Ron Paul came along, got interested in libertarianism, anarcho-capitalism. Then I got my bachelor's and master's in accounting at UT Austin. And the last year of graduate school at UT Austin, I was part of something called the Mises Circle, which was like a reading group for Austrian economics. And I was part of that with Michael Goldstein and Daniel Krawietz. And we were debating fractional reserve banking and 100% reserve banking. And at some point, the subject of Bitcoin came up. Once I realized, and I'd heard about it like once before because of the Silk Road, but I didn't really, it didn't cross my mind that this was an interesting issue, despite the fact that, I'd been reading about Austrian monetary economics since I was a junior in high school. But when I heard about it the second time, I actually, did a little bit of research and found its monetary policy. And when I saw that chart of like, there's only going to be ever be 21 million Bitcoins, it immediately struck me that this was a very, very interesting economic experiment, that if it was successful, would ultimately lead to the demise of fiat currencies, which I'd been kind of railing against, with the Fed and whatnot for years. And so that's where things started at late 2012, early 2013 for me.
So the Mises Circle, is that how you and Michael met?
Yeah, that's right. So we, I knew of him on Facebook because I was in some of the same groups, but I'd never hung out with the libertarians in real life at UT Austin before that. And so, I just remember walking into this classroom and Michael was sitting, shit posting memes on Facebook about Ludwig von Mises. So we quickly became friends.
And now I know that you and Michael kind of do the Satoshi Nakamoto Institute thing, and you've got a couple of other projects. What do you do in the meat space? Like, do you have a day job?
So I was working as a software engineer until I had my son in February, and I've been on paternity leave since. But yeah, I've got to get a day job at some point and make some more income. But in the meantime, enjoying time with my son and getting lots of time to do Bitcoin related things.
Let's start out with kind of going over, you had an article right before the BitBlock Boom conference, and then you kind of talked about these ideas again at the conference about Bitcoin governance. You talked about like this idea of Bitcoin being intersubjective and that objective governance creates a single point of failure. Can you kind of expand on that a little bit?
It kind of operates on multiple different levels, but basically, I mean, if we're talking about Bitcoin's governance, the consensus rules, that is the transaction and validation verification rules that everyone agrees upon, and we kind of globally call consensus, those exist as an intersubjective reality in the sense that they are they're not chosen objectively by whether it's Satoshi or by any one person or any one group of people like the miners or something like that. Rather, they're software that's chosen to be run by this set of nodes. And the people making those choices are free individuals looking at, free and open source software. So it's up to them to kind of form this emergent consensus of what Bitcoin is. And that's an intersubjective reality in the sense that the Bitcoin Cash people who, for some strange reason, are in RBTC, they should be in RBCH, but they believe that Bitcoin is Bitcoin Cash, and that Bitcoin Cash is Bitcoin. So they are living in their own intersubjective reality, while I think most of the rest of the world understands that Bitcoin is one specific currency, money that's attached to a specific set of validation rules and a history, a blockchain.
How important is social signaling? So let me just preface this with I've seen the UASF hats, and for my own self, it was probably about a year ago when people were talking about SegWit that I owned Bitcoin, but I didn't understand it. Like I had a loose understanding of how blockchain worked, but I did not I hadn't been in the forums. I hadn't really done any technical reading. And so between the UASF and then after that, but before 2X is when I kind of started doing the technical deep dive and actually understanding how things work. But from someone who was there kind of at that time and seen other things before that, how important is this idea of social signaling?
Yeah, that's a really interesting question. So if I think back on my own experience with I think the premier and there's just no other debate that's comparable to it in the history of Bitcoin's governance, which is the block size limit. And when I look back, I had a view on it from the moment I got into Bitcoin and heard about this 1 megabyte limit, that it just, when I read the white paper and saw that the block reward would be replaced by transaction fees, it became apparent to me that means that there needs to be a fee market and pressure for higher fees, because the relying on the technical limitations of block propagation times and self-restraint by miners seemed to be a quick way to get everything centralized, where basically you wouldn't be able to run a node that ultimately is how you automate the your subjective view of what the Bitcoin verification rules are. So it intuitively made sense to me that there would be denial of service limitations on things in the protocol. And so we see that with the block size limit, but there's also SIGOPS per block limit and SIGOPS per transaction limit to minimize the amount of, or at least mitigate the resource usage from transactors on the network. And so because they're a negative externality on nodes. So I saw the biggest issue with hash rate is it being too low in the long run. And to prevent the hash rate being too low in the long run, this limit on the block size, whatever it may be, as time evolves, but it's crucial because if you're trying to think about how a business would maximize revenue, if they are a monopoly, and so miners are a monopoly on timestamping, on this secure timestamping. The secure timestamping function of Bitcoin is a unique thing. So there's no way to it's not like there would be two competing timestamping functions within Bitcoin. Like theoretically that's possible, but that doesn't exist. And so basically this timestamping function is a monopoly. And if you think about how to maximize the revenue for a monopoly, it's not the case that you just release or create as many goods as the market needs, as people need, because your marginal revenue starts dropping dramatically. And by limiting supply and creating artificial scarcity, you can drive up total revenue beyond just what you would have gotten from having more marginal revenue from producing more units. So like, I mean, the classic example would be like a luxury good, right? Like, so a limited edition Lamborghini, you only make 400 of them. And presumably the total revenue you get from that would be greater than mass producing these, because they would just lose their collector's value. So that's kind of the way I was thinking about the issue of revenue maximization to prevent a too low hash rate once the block reward gets phased out. And the reason you want to have a healthy hash rate, and we can debate about what level or what range of hash rate makes sense, but basically the lower the hash rate is, the more confirmations you have to wait for if you want to have the same guarantees, all else equal. So today the rule of thumb is like 6 confirmations. If hash rate was quote unquote too low, maybe it would be like 60 confirmations or 600 confirmations. And then that is directly tied to also the amount of value being transacted. So, if people are using Bitcoin as a means of global settlement, and that would mean that you would have, multi-billion dollar transactions, payments going through the Bitcoin network, and it would be bad if people had to wait years before being able to spend those because the hash rate's too low. So real quick, I'm just curious, what are you saying would cause that hash rate to be too low? Well, because of the block reward halvings. So we have these halvings and they're very aggressive, right? And so basically, I actually had the spreadsheet open earlier today, but it's a dramatic drop off in terms of what percentage of the stock to flow ratio, how that's affected. So every 4 years, we go from 50 Bitcoins created every 10 minutes to 25 to 12.5 to 6.25, etc. And if over the long run, if those halvings don't have or are not coinciding with an increase in the transaction fees, which go to the miners, that means that the miners' total revenue is drifting down and getting halved every 4 years. And at some point, the block reward, in 2100 is 0. But that's not really the relevant point in time to be looking at. Like it's the problem is not going to arise when we go to a block reward of 0. The problem is going to arise probably within, I would argue, like 12 years to 16 years. So by no means, like I say, it's long run, but really, I mean, it's not really that long run. There's
right.
And
at least for people with a low time preference.
Yeah, exactly. It's like, it's well within our lifetimes. We're all very young. So it's something that is important to be thinking about. And especially because when do you want to break user expectations is the question. So do you want people to be dependent on cheap layer 1 transactions until it's too late? Or do you want to break that expectation early on in the system so that people have more time to adapt and create layer 2 solutions, whether they're trustless or trusted?
Yeah. The longer you put the problem off, the worse it, inevitably it's going to happen. And so the worse it'll be, or the more drastic it'll have to be whenever it actually happens.
Yeah, I want to come back to your original question, because it was a very interesting question about the signaling and how much it matters. I'm almost there. I debated this issue with Gavin Andreessen on IRC back in the day, and I thought that his point of view reflected the point of view of the rest of the Bitcoin Core contributors at the time, because he was leading the project. He was putting out blog posts that were talking about 16 megabyte, 32 megabyte blocks. And so at the time, I thought, wow, these Bitcoin Core developers are nuts. They want massive blocks. And like people like Mike Hearn and Jeff Garzik, they seem to be going along with it. And they're like well-known people, developers, certainly better known than the other ones at the time. And so that I use that example because I thought I was also, when I read like Reddit threads and whatnot, I thought that I was in the minority with regards to the issue of the block size limit. And I thought that the situation was basically, a already baked in conclusion that there was going to be block size limit increases, despite my opposition and my belief that they are bad for Bitcoin in the long term. And it really wasn't until Twitter, but I would say the resistance towards XT at the time was the first hard fork attempt, and then there were other ones, like Bitcoin Classic, and seeing the opposition with each new attempt grow louder and louder and stronger, and that crescendoed into the No2X movement in November, when their whole thing fell apart, and victory was achieved. But I think that the social signaling is really important. The problem is that you never know if you're getting sybiled or not. So you have to have a web of trust that allows you to see these signals and trust them. Because if you just see these signals in terms of sock puppet, Twitter or Reddit accounts that were bought and paid for, and they're just putting out this information, and you don't even know who these people are, or they don't have a years-long background in the industry, or commenting on Bitcoin or being on Twitter and shit posting. It's very easy to be misled about where the support is. They'll ballot stuff the polls and all this. But if you have a web of trust, that is that people that have been around for a while now, and you've seen them generally say things that you agree with, and even people that have attached their real identities to their Twitter profile, or you've met in real life and, have allowed themselves to be doxxed. So that begins to form a web of trust that then when you have signals about what does the community support or not, you can verify that in your web of trust pretty easily. That's my spiel on that.
Yeah. So I don't know. That's just funny to me. I see what you're saying, and I agree. But it's just funny. We're building this network of trust minimized, interactions, and yet at some point when these changes happen, trust still is very important.
Well, to an extent, right? Because let's say that the people you were trusting were not trustworthy. That means that basically, if you were doing UASF, right, for example, then your node would stall out because no blocks would be getting mined for you. And so you kind of have to look at okay, if this trust was betrayed, what are the consequences? In the case of something like UASF, for For the most part. I mean, I know that there's situations where there could be a loss of funds or wider issues, but for the most part, it seems like if you were misled into running this node that has a consensus rules that no one else is going to follow, there's no consequences for that. In fact, you could just run a UASF node and a, let's call it Satoshi legacy node simultaneously. Okay. And so in that regard, I think that's why it's basically a Schelling point, is my argument too, is that a Schelling point consensus, or a Schelling point, is something that two parties come to without ever communicating with each other. So like one example is, and this is my favorite example, is if you were in New York City. I don't know, have you visited New York City, Josh?
I have. I've been twice briefly.
So let's see if this Schelling point experiment it works out. So you're in New York City and someone else is in New York City and you're going to meet them on a specific day, but you don't know at what specific time and you don't know at what specific location. So you have to think about, where would this other person expect to meet me, and where do they expect that I would expect to meet them? So it's kind of like a circular thing, because you can't communicate with this other person. So what time of day and what location would you pick?
Do I get to know anything about the other person, or that's it?
That's part of the Schelling point, is that you're basically you're only reliant on like your past personal experience, but also B, your understanding of the topography of New York City and all of the different options that are available to you in terms of meeting places and their relative benefits versus other locations of meeting. And then, the time is obviously you've got 24 hours on the clock, but you also would want to think about, when would someone want to meet? What time would be convenient for the average person?
Yeah. Right. So I'm going to go with so not having a good understanding of like paths to get around the city. So I don't have a good understanding of like the train system or the buses or anything like that. So not knowing that, I'm going to go with the Empire State Building at noon.
All right. So you're half right. Noon is correct. But it would actually, most people, and so like that's the thing too, is that there's several different Schelling points. So in this example, you have ended up with the Bcash people at the Empire State Building, because all the Bitcoiners are at Grand Central Station. Yeah.
Okay. I can see that. That makes more sense.
Yeah, so that I think illustrates the concept of a Schelling point. And so if you were to survey 1,000 New Yorkers, you would find that 800 of them would tell you Grand Central Station, and then the rest would be off in Looney Land, either at the Empire State Building or the Statue of Liberty or the Brooklyn Bridge. Like there's or Central Park or something.
Right.
Yeah.
See, I wasn't going to pick Statue of Liberty because of the. It takes a lot more effort to get there. I know that much.
For sure.
And when you say Grand Central Station, that makes sense, of course, because it's such a hub of transit. Yeah. So, but I wasn't thinking transportation wise. So, okay. But noon is the correct time?
Noon is the correct time. Yeah. That's just the most convenient time for everyone, right?
So you're trying, so Schelling is like, you're trying to guess what someone else would guess that you would guess.
Right. And you don't have information from them, you can't communicate with them. And so I think that if we assume that social signaling on Twitter is compromised, which I think, is a good, healthy assumption to have, then you are playing a Schelling point game. And it kind of falls on, do you think that other people are going to run UASF? And then that means that you got to do research on the topography of Bitcoin, right? And so and the possible different sets of Bitcoin validation rules. And you got to look at these different validation rules and kind of think well, so first of all, there's a huge default towards the existing validation rules. And so you've got to keep that in your mental model. But otherwise, you're evaluating these different validation rules and thinking about whether other people are going to show up that Schelling point with you.
Okay. So then why, since we're kind of in that same time frame a year later as when UASF and the hard fork and all this stuff happened, why, my understanding was at least at some point of a good majority of the mining consensus was leaning towards Bcash. Explain to me why. I mean, I think I have an idea, but like why that doesn't matter. Yeah. And maybe 2x is a better example.
Yeah, for sure. So the reason that the miners didn't really matter for the SegWit 2x issue, they committed to participating for up to 24 hours and essentially be mining at a loss, because what happens is that if miners, first of all, if 90% of the miners leave, that means that mining a block takes 10 times longer. So that's 100 minutes. So an hour and 40 minutes. So that means that Bitcoin blocks would still, the legacy chain Bitcoin blocks would still be getting mined, every hour and 40 minutes, assuming that its value remained the same on the exchanges, right? Because then if the miners would leave even more if the value dropped on the exchanges. The SegWit 2x people thought that by taking the hash rate and directing it in another direction, they could cause the exchange rate at which Bitcoin is trading to change. And so essentially that the BTC chain would collapse in value and the S2X chain would increase in value from the miners doing that. And they kind of got backed into this silly charitable mining theory because they tried to have it so that there was no replay protection. So that essentially exchanges would not be able to list both the old chain and the new chain, but rather that they would be forced to go along with the quote unquote upgrade. But what ended up happening is that exchanges implemented replay protection manually. And so that generally entails mixing Bitcoins that were mined in the other chain with their coins in transactions. And so by mixing the block reward in with your coins, you can cause them to be replay protected on that chain. So this made it such that the exchanges would have been able to list both the SegWit 2x coin and the Bitcoin. And thus, they would be trading in value, and the miners understood quickly by looking at the futures prices that showed that Bitcoin would have 90% of the value, that they wouldn't be mining this S2X coin for very long because it would be so unprofitable to do. And really kind of, it's a vicious prisoner's dilemma, because if the first miner to defect, gets more and more transaction fee revenue based on the mempool backlog that's building up. Something that Bcashers often miss is that while nodes do not mine blocks, right? Miners do. Nodes do have mempools that accumulate transactions that have an escalating transaction fee attached to them. So at some point, a miner is incentivized to defect and come along and mine the chain that has value. And this actually, I think the part of this misunderstanding is like a difference between the classical / Marxist labor theory of value and the Austrian individual subjectivist theory or marginal theory of value. So they kind of got tripped up on their economics there. And that's why 90% of the miners not liking Bitcoin is okay. I mean, they're mercenaries. I don't really care if they like Bitcoin or not. They're just there to provide a secure timestamping function for the consensus rules.
Right. And for those who aren't aware, so the Marxist, let me see if I can do this real quick. So the Marxist labor theory of value says that this product required X amount of labor put in by the worker, and so it therefore should cost that many dollars or whatever, or correlated, have a correlated value to how much labor was put into it, versus the Austrian view is that the value of a thing is determined by the person. It's a subjective value determined by the person who's willing to pay for it.
Exactly. That's exactly right.
I wasn't sure if I was going to be able to do that quickly or not, but
no, that was a flawless explanation of those. Yep.
So while we're talking about social things, I've heard you talk a number of times about the benefits of creating your own Twitter echo chamber. So why do you think that's good? Because I know that there's a lot of people, and this is not in Bitcoin necessarily in particular, but there's a lot of people in general right now who, let's say in American politics or whatever, in just looking at how extreme, different sides get, and just say like, we need to, this only happens because we close ourselves off and we don't listen to the other side. And then it gets so extreme that we're not even on the same planet anymore, in a sense. So they say that, instead we should be listening to people from all sides of the argument and conversing with them. Why do you say that an echo chamber is good?
So I don't know that assessment of politics is correct. Like, to me, the reason people become so conflicted in conflict with each other over politics, in my view, is because of the ever expanding reach of the federal government and the ever decreasing amount of local control over issues. So whether it's like the Second Amendment or abortion or whatever, and that essentially different groups of people are going to evolve in different directions. And so I think that different parts of the U.S. should be able to have their own policies, and then we wouldn't have to have these big national debates where your policy is either forced upon others or other people's policies are forced upon you. And so I think that Bitcoin's solution to that is that if you don't like the policies of the current Schelling point, then you are free to create your own cryptocurrency and fork off or create something from scratch. So in that context, I don't see an issue with essentially censoring out any views that I don't generally agree with. And there's different forms of me rationalizing / justifying this, but at the end of the day, it's like I enjoy Twitter to the extent that I can filter what is getting into my feed. And I would cease enjoying Twitter or visiting it if the feed didn't provide me with things that I found to be pleasant and interesting. And really, I mean, there's a lot of exaggeration in the sense that me being in a filter bubble and being in an echo chamber, you'd be amazed by the amount of controversy that exists within this echo chamber and how many people disagree with each other and the arguments that I have. And so I don't think that. Well, so the other aspect of it is that having been around for 5 years now, I think I've heard every stupid argument and every intelligent argument for and against every topic in crypto. And people like to think that their project is new and interesting, but generally just fits into a pre-existing category of being an app coin or an altcoin or a security or a gift card or airline miles. It's not they're going to come up with something that's whoa, this is a new form of economic good that I had not ever imagined would happen. No one's going to repeat what Satoshi did and make something come out of thin air. It's just people aping or doing live action role play of being innovators.
Yeah. No, I agree, and I mean, some of that was just, I just wanted to hear the way you said it. I agree on the stuff about federal control, and that, you know, giving more control back to the states would be good, or even them. I think I'd be okay with a lot of secession. And then with Twitter, I mean, everybody's got their own version of, to some extent, right? Like I can't control the algorithms, but I can control my filters. And if I don't want to hear what someone has to say, I can mute them or block them or whatever. And so everybody does it to some extent. It's,
you know, I will say, and I can't emphasize this point enough, is that 90% of the problem is the quality of the people who disagree with me. And so, like, I'm serious. Like, I follow, you know, Preston Barron, who's like a crypto skeptic and a Bitcoin skeptic. And I think he expresses himself intelligently and has intelligent arguments. And so there's no reason for me to mute, block, or not follow him. But like all of these people who, you know, have like drive-by tweets that are just like weak attempts at trolling, you know, like if you're going to be trolling, like make it, put effort into it. It's not just like, oh, you know, you're paid off by Blockstream, or, you know, oh, you're just like a core troll shilling for a SegWit coin. It's like, that's not going to, that you're going to get muted. Like that's instantly going to happen. It's not like I'm going to be like, oh, let me follow up with that and see what arguments he has. And then I'll see if I can change my mind or if I'm unpersuaded. Like that's just, in that context, that's just never going to happen. Now, if they'd entered my feed and entered my mentions with a thought-provoking and like at least semi-respectful, I'm not asking you to like kiss my ass, but just like not be abusive, then maybe I'll read it and actually follow up on it. But yeah, that's the other thing too, is that why not have an echo chamber if like most of it is just sewage?
Yeah, repetitive sewage.
Yeah.
Okay, so moving. You're in New York, correct?
Yeah, correct.
Okay, so being there and kind of being near all of the, I mean, this is a rough segue here, but being around kind of the financial side of things, the traditional finance side of things, I think there's been a lot of talk, and you know, this ETF yes no thing. You know, people talk about institutional money. And institutional money is coming into Bitcoin. It's definitely coming in now, or it's not coming in now, or whatever. And there's a lot of people that say, oh, this would be really good, or whatever. Well, kind of what are your thoughts on that? And like, what does that even mean, I guess, for somebody who, you know, maybe for younger audiences that don't actually have an understanding of what institutional money means? Like, what does that mean? And do you think that we need it, or that it would be good for Bitcoin, or whatever?
Yeah, sure. So I would just start with like defining what a retail investor is. And so if you are living paycheck to paycheck, you know, with your W-2 and you're an employee, and you have no savings, right? And thus you're not able to invest in anything. And so you are not even a retail investor. Okay, now let's say you are saving 10 to 20% of your salary and putting that away. You're investing in your 401k, and you're investing in your retirement accounts. And after that, you even have money left over. So you are investing in your taxable accounts, and you're building up a nest egg to buy a house, or to quit your day job and try to start your own business. So at that point, you're a retail investor. And so there's different ways that a retail investor invests, whether it's through, you know, tax deferred or tax advantaged retirement accounts, taxable accounts, and they do this through financial institutions. And so, for example, something that has been kind of in the air is Fidelity Investments is kind of a platform for a lot of retail investors who have, you know, their their investment accounts with Fidelity. And there's been noise about Fidelity adding Bitcoin as kind of like, essentially having Coinbase inside of Fidelity, where you would be able to buy Bitcoins in your taxable or potentially your retirement accounts. And so that's kind of like the first way that you could think about quote unquote institutional investment being involved, which is that financial institutions providing access to retail investors as a way of diversifying their portfolios. So now with individual retail investors, you can get into like high net worth individuals, right? And so there they've got different ways of investing, and maybe they can invest in Bitcoin futures already, and so they've got that covered. But they'll go and they're accredited investors and whatnot, and they'll go invest in their buddy's hedge fund or a private equity firm or however it may be, or their nephew's crypto hedge fund. And so there's kind of another way of quote unquote institutional investment it's like all of these new crypto hedge funds that are especially marketing themselves as, hey, we're going to be doing different kinds of strategies around Bitcoin and cryptocurrencies to provide a return to your investment. So like these strategies range from things like doing arbitrage between exchanges or trying to do some like high frequency trading in the order book and market making, to actually doing fundamental research on different coins and kind of coming up with a view on, hey, this is going to outperform Bitcoin or do well in dollar terms or whatever it may be. And then kind of the degenerate form of that of, I am friends with this guy who's doing an ICO and he's giving me a pre-allocation and I'll help him pump it and like get retail investors to buy it based on a false narrative. So that's kind of like the shadier aspect of it. But there was another thing. Oh yeah, just like participating in like pump and dumps and keeping an eye on sentiment on Twitter and kind of figuring out ways to allocate capital that way. And like a lot of these things had been done by individuals in the past and kind of on their own account. Now, what's different here is that these crypto hedge funds have money from outside investors who may or may not have any idea as to what cryptocurrencies are and whatnot. They're just seeing an opportunity here based on what they saw on CNBC or whatever. So that definitely exists today, and they have put hundreds of millions, if not, probably just hundreds of millions of dollars into the cryptocurrency markets widely. But I mean, any of these guys, like they have some allocation to Bitcoin, even if they're complete shitcoiners, like that just can't help themselves. They will have some, 10% to 60% allocation on like a market cap weighted basis. And you also have index funds. So there's like this index fund called Hold 10. And there it's like a crypto hedge fund, except they're saying, we're going to buy the top 10 cryptocurrencies and we're going to passively hold them and we'll rebalance as time goes by. But we're not actually doing any research on these underlying protocols, or we're not actively trading or anything like that. It's just passive exposure to this group of cryptocurrencies. So that's another vehicle that is accessible to high net worth individuals and kind of becomes an institutional investor in its own right. And that's when so past high net worth individuals doing these things, there's what's called family offices, which is basically like at some point someone has so much money that they basically need to have their own or want to have their own investment firm to be making these trades or these coming up with these investment theses and different allocations and whatnot on their own without using a crypto hedge fund, or maybe they're like a fund of funds, right? And they're investing in crypto hedge funds in 10 different crypto hedge funds, thinking that, hey, one of these is not a scam. And so that is actually that. I think that's like the current wave of institutional investors getting involved, and that's very much like the tip of the spear. They are at the forefront of this because basically they don't have the limitations that a lot of other institutional investors have, and also it's a situation where, hey, if the family, if the person who is whose wealth this is in the family office thinks that Bitcoin's a good idea, and was convinced by his golf buddy that Bitcoin's legit, they can set the direction of where the investments are going to go without having to consult or having much red tape compared to a different kind of company. So, for example, like I think the very late adopters in crypto are going to be the very large hedge funds, right? So the hedge funds that have billions of dollars under management, they're going to they just because they're older and they're bigger and they have more processes and they're more limited in the scope that they can have compared to like a family office, it's just going to take them longer to invest in Bitcoin. And so the reason that this matters for Bitcoiners is because it's just a continuation of the trend, right? So, we started out with like very poor retail investors who didn't know what they're doing, and we still have a lot of that. And gradually you had like the Winklevoss twins, put in like millions of dollars.
Right.
And that happened in 2013, early 2013. So like you could consider that to be like, and then there was like Barry Silbert too. You can consider them to be like the first big whales that moved in that are like public and well known. So it's a continuation of the trend. It indicates that Bitcoin is increasingly liquid. An increasing number of people are understanding the investment theses for Bitcoin and realize that its potential is massive and also has a high percentage chance of actually being realized. And it's still undervalued relative to that.
So do you think I'm trying to think how to word this. Do you think big institutional investors are necessary to get us to hyper Bitcoinization, or does it just speed things along and eventually we would get there anyway?
Yeah, that's an interesting question. Definitely the latter. And then we can argue about how much they speed things up. Because I think that if all of us just kept, hodling as retail investors, like we would get there, because the millennials, quote unquote, like they are the rising generation and they're investing in Bitcoin as like, every 2 weeks with their paycheck, they put a little away in Bitcoin, and a lot of them are like actively trading it and whatnot. And so eventually the retail investors would cause hyper Bitcoinization in the sense that there would just be very little demand for dollars and you'd have a currency substitution effect. But realistically, like the entry of institutional investors dramatically accelerates the pace at which we're going to have full currency substitution. And the reason that is that the best way to really pour gasoline on the flames of Bitcoin is to borrow fiat from the fractional reserve banking system and thus create money in the fiat system and buy Bitcoins with that. And so that's kind of like leveraged buying of Bitcoins, where you're getting your leverage from the fiat system. And that introduces a feedback loop where they're essentially printing money to acquire Bitcoins. And then the dollar collapses. And that's kind of just a speculative attack. So you don't want retail investors doing this, because they're going to be borrowing against like their house or their credit cards. And essentially like if things go bad, right? So if we're into a prolonged bear market and they're over leveraged, and then they have to like panic sell to, meet their mortgage payment or whatever, like that's a bad situation. And then they need somewhere to live. And now they've got to get foreclosed upon and move out of their house. So you don't want retail investors getting leveraged up. That's not a good outcome. What you want is institutional investors who are getting leveraged up, borrowing money from banks and using trash like treasuries or stocks as collateral, and using those to leverage up. And so if things go bad, well, okay, this guy's like not a billionaire anymore. He's only 100 millionaire. But it's not like someone's out on the street homeless. And that's why now, granted, like there's a lot of institutional investors that are investing on behalf of other people. So like pension funds, like they should not be getting involved in Bitcoin, and they especially should not be getting involved with making leveraged, purchases of Bitcoins in an attempt to cause a speculative attack. Like it would be very irresponsible of them given their constituency. But if you are like George Soros and you don't give a fuck, you're just trying to make money, then sure, why not go for broke and try a speculative attack against Bitcoin?
So a lot of it has to do with the fact that they have access to different opportunities than us plebes, and then also that the risk is less to them.
Yeah, exactly. And so the other aspect of it that is good to think about is like, like Chiefy, when he was unnoted, he was talking about like central banks buying Bitcoins with 1% of their reserves, right? And so like they would not notice if 1% disappeared because they're making like 5 to 8% a year, And that 1%, though, for an institutional investor might represent hundreds of millions, if not billions of dollars, which for us plebes would be like a fortune. So because they're very diversified, it dilutes the risk. And then really the main thing, though, in my mind is that how can you access credit, right? And so if your only way of accessing credit is by putting at risk something that you need to make money, like your car, for example, like it would suck that your car gets repossessed because you were like overextended on your Bitcoin purchases. Because then you can't make more money in your est.
Yep. And then to kind of bring it back to what we were talking about earlier, do these, I guess, especially if you've got these institutional people, if they're public and open about this, maybe not necessarily with their exact amount that they've got in it, but just the fact that they are, that probably brings back in a social effect again of like other people, like let's say tomorrow, somebody like Bill Gates or Charlie Munger or Warren Buffett changed their stance and said, well, okay, like I guess it, a small amount going in is fine. I've seen so many people that are like, yeah, see, Warren Buffett says Bitcoin's a bad idea. Like, does their position change, and does that bring in more retail investors?
Yeah, for sure. I mean, there's like a huge number of people who worship Warren Buffett and will do whatever he tells them, to do. So that's definitely the case, which I think that means that, it makes sense that someone like Warren Buffett, well, first of all, just like his investment style is very much focused on equities. But the other thing, too, is that as a public figure like that, like you could single-handedly cause, a crisis and cause the collapse of the US dollar if you go out there saying stuff like that. So I think that like they kind of understand that role of theirs, and so they would not publicly come out and say something like that. On top of just like the other thing too is that like right now that would destroy their reputation within their community.
Oh yeah, sure.
And so they would be
and it would
like
also
going off the deep end.
Well, and it also, like, if it happened quickly, would destroy a lot of the wealth that they've made on the U.S. dollar.
Yeah, to a certain extent. Granted, like the Berkshire Hathaway companies will still be producing real goods and services that will be getting bought and sold in Bitcoin. So they'll still have like cash flow, but yeah, it would not be like anything that's like a bond that has a fixed like dollar value to it would be wiped out. So it'd be like a huge debt jubilee in terms of like all this student loan debt, all of this housing debt would all be entirely worthless, and so people would just own their homes, without any debt, which would be a really interesting economic experiment. And that might be the most exciting part about. I hadn't really thought about that until I just said it right now. So I'll start tweeting about it after this podcast.
Fantastic. All right. Okay. Well, so let's talk about your projects that you're working on then. You've got, where did I write all this stuff down? Oh, so you just have like a personal, like advising stuff, right?
Yep, that's right. So there, like, I'm focused on explaining the different investment theses for Bitcoin, and then explaining how Bitcoin's underlying technology works. Like, why is it that there can only be 21 million Bitcoins? And then, obviously, Bitcoin's governance is a part of that.
Gotcha. And then Bitcoin Acts.
Yeah, so Bitcoin Acts. Yeah, I was one of my focuses on, because of my accounting background, I'm very interested in Bitcoin's wallets, and also I think that there's some importance to the Bitcoin Core wallet in the sense that right now the Electrum wallet is seen as the most useful one for users, and so people run like an Electrum personal server, and the Bitcoin Core wallet I think has room for improvement. And so I've been involved with doing code reviews and adding my own code to the Bitcoin wallet, Bitcoin Core wallet. And so as I was doing these code reviews and that's kind of the first step to like learning how to contribute to a code base is by reviewing the changes that are going in. I realized that there's some difficulty in finding pull requests that I would find interesting, and being able to quickly see the current state of a pull request. And because it's not like most pieces of software where basically you have one person who writes the code and then maybe another person who reviews it and rubber stamps it and it moves along. In Bitcoin, like there can be a half dozen people who review a pull request and do so in an in-depth manner and provide very, very high quality comments that then you would respond to and modify your code and update your pull request. And so this process of back and forth between reviewers and authors of pull requests, I found to be highly rewarding and also a little bit frustrating at times. So that's when I realized that, hey, other people are having the same kinds of issues I am, and a web interface would actually help alleviate some of these problems. So that's when I created bitcoinax.com. And there, basically, you see the list of pull requests, but information about the pull requests that you would otherwise only be able to see by scrolling through all the comments, those comments I automatically parse and then bring up to a top-level view on the homepage of Bitcoin X.
Very cool. And just for people who aren't aware, what does ACK mean?
So ACK is short for acknowledge, but really what it means is that the person who is reviewing the code has approved it and said that they would, essentially be comfortable with it getting merged into the Bitcoin reference implementation.
Yeah. And so for anybody who hasn't, who doesn't have at least a basic understanding of how that process works, you guys had a noted episode with John Newberry that was really helpful for me in understanding how that stuff worked. I don't remember what episode that number is, but I'll put a link in the show notes to that.
Yeah, definitely. And we're going to have John Newberry back on the podcast this week. So look forward to that.
Very cool. So that might actually be out before this episode is. We'll see.
We'll see. I'm recording it tomorrow.
Well, cool. So anything you want to plug? People can find you on Twitter at Pierre Rochard. There's an underscore in there somewhere, isn't there?
Yeah, it's Pierre_Rochard. So definitely that's where I'm at all the time. And DMs are open if you want to reach out.
Also the noted Bitcoin podcast and bitcoinaxe.com. I'll put links to all those in the show notes. This is episode 24. So bottomshelfbitcoin.com/24 is where all that will be. Anything else, Pierre?
No, I mean, go to the Nakamoto Institute, read everything that I've written there, that everyone's written there. And also, I mean, I think that everyone should read Mastering Bitcoin by Andreas Antonopoulos. And if they have the means or the scholarship to do so, to go take the Programming Blockchain class by Jimmy Song.
Yeah, very cool. I finally finished the Bitcoin standard, so Mastering Bitcoin is next on my list. I haven't got to that one yet.
Fantastic. Yeah, I mean, that's the perfect combination. Like, that's the 1-2 punch, the technology and the economics, and then after that, you're good to go.
Yeah, I have to actually get the physical version of that one, though, because I kind of get the feeling with that one, listening to it on Audible is not going to be sufficient.
Yeah, no, and I got the physical one as well, and it's just good to, like, if you're going on a commute or whatever where, well, I guess, I mean, I don't know if you drive on your commute, but...
Yeah, I drive, unfortunately.
Yeah, gotcha. Yeah, so, I mean, but honestly, I think that it's worth, like, waking up early in the morning, having some coffee, and just, like, reading a chapter.
Very cool. Cool. All right, man. Well, I really appreciate your time. Thanks for coming on the show.
Yeah, thanks for having me on. Appreciate it.
All right, Bottom Shelfers, that's going to do it for our show today. Remember, you can help us out by rating the show on iTunes or Stitcher or wherever you get your podcasts. And you can support the show with one-time or regular donations through Patreon. You can also donate with Bitcoin through my Paynim address or through BTC Pay server. I've got links for those on the website, bottomshelfbitcoin.com/donate. I also had some conversations with someone wanting to donate to the show and kind of ran into this issue that I don't actually have a simplified way of allowing you to donate with Bitcoin. So I am going to be working on that. I may be doing something where I have a different address up for each episode or something like that. I don't know. I'm working on it. So just know that. But also, I know this episode is coming out late. The more that you guys support the show, the less these come out late, because I do have other jobs that pay my bills, and if this show is paying more of my bills, then this show gets priority. So that would be awesome. Let's see, what else? Don't forget to follow me on Twitter at BottomshelfBTC. I've actually also decided to start cross-posting on Mastodon. If you don't know what Mastodon is, it is a decentralized social media. So we'll see how that goes. I'm not necessarily the decentralize all the things guy, but I've also seen recently how some people were deplatformed in coordinated moves by big social media companies and kind of just lost all of their access to their audience at once. So I also think it's smart to be spread out across multiple platforms. So I may be behind a couple episodes on posting to YouTube. I'll try and get caught up on that. That's just not my primary thing. Audio is my primary thing. So I'm on Twitter at BottomshelfBTC. I'm on Mastodon at BottomshelfBTC at mastodon.social. And what else? I'm on Instagram, but that's mostly just memes. So and when I get a good meme, I post it on Twitter anyway. So, and now Mastodon, I guess. So hit me up on those, like and subscribe so you don't miss a single episode of the show. That goes back to the podcast thing, but whatever. Anyways, all right, guys. Next week I've got Adam Gibson, one of the maintainers of Join Market, coming on to talk about coin joins and join market and privacy and fungibility and all kinds of stuff. So come back and listen, and I really should have that one out on Tuesday next week. All right. From Bottom Shelf Bitcoin, I'm Josh Humphrey. Thanks for listening.